Attention next week will be on Q2 GDP, labour data, CPI, RPI, inflation. The next Bank of England decision is on the 23rd of September. And you can see that they're looking at the pound US 2-year swap spread. So they're looking at basically the carry trade on this one. And the black line being the carry trade, of course, and the red line being the pound dollar. There are tentative signs of a resumption of the late July rally above 139 would add confidence to that view, with a target of a recent peak of 39.85s. There's plenty of UK data over the next week for upside surprise potential, with growth, labour and inflation all featuring. The reopening of the economy, expected resultant economic recovery and less stimulatory monetary policy should support sterling. That said, the Bank of England has signalled a clear and predictable path for the removal of QE, but also one which is designed to minimise market disruption, so that any upside moves on the pound in response are likely to be measured. Health outcomes are firmly in the mix. Cases fell in the second half of July and have stalled so far in August. Hospitalisations have fallen slightly in August. Such improvements are probably related to the high vaccine rates. By global standards, 60% of the UK population is fully vaccinated, 75% of adults, putting the UK in the top 10 countries. And that's basically all they said. That was it. That was their entirety. And obviously the idea is that the rate differentials starting to show up here through April and through June and through July. You can see that that interest rate differential is starting to appear on the screen as far as sterling is concerned, and you can obviously start looking into those. Those types of stories. Now, when you're thinking about that storyline, I always think it's a good idea for people. It's a good idea for people just to get a kind of better fix on this as the storyline evolves, isn't it? It's always important that you can start to recognize perhaps some of the elements that make up the kind of ideas that you're looking at as traders. It's always important that you don't just take this screen as read. You actually look into this screen and you start looking at those relationships. And that's important, isn't it? Because what you're trying to do is you're trying to understand what it is they're saying and why they're saying it. You're trying to figure out what their ideas are. And they're looking at the 2-year rate differentials, aren't they? They're really looking at the swaps, but obviously you can try and mirror this chart by putting on the US UK 2-year yield differentials. And that's something that you can start to recognize on your screens. You can put it on, you can see it, you can start looking at it. Now, it's not going to be exact. It's not going to be exact, but it's going to be close enough because you don't have the swap rates on your trading view. It's not one of those things you have on TradingView as a standard product. But obviously the 2-year yield differential can still give us some of that insight, can't it? So if we look at that chart there, and we start looking at that period, this big ramp up in January to 2020, we can start trying to mirror that chart, can't we? So let's take a look at the sterling chart for the same period using the 2x2s, and this is what it looks like. You're able to recognize that this is the 2-year differential coming up here. That's the same rally as you saw here, of course it is. And this obviously, this scoops out just a little bit. The 2-year doesn't quite drop as much, and the reason why that scoops out on the swaps is because of weakness on the 10-year carry. This is the 10-year carry here. You can see the 10-year carry just scooped out a little bit more than the 2s did. And that added a little bit extra into the swap differentials, but it doesn't make much of a difference. So when we looked at, when you look at the right-hand edge, you'll see that the right-hand edge has exactly the same feature in terms of this short-term 2x2 swap storyline. You can see on the far right-hand edge of sterling 2x2s, you can see that we are seeing quite a solid 2-year swap diff, which is pretty much what these guys are showing in terms of that right-hand side. And that's one of the reasons why they're saying that this has a probability of being able to rally in the background. Now, obviously, this differential is going to be very, very important, but it's a differential. So if the US economy gains faster than the UK economy, then sterling can still benefit from that because of the way that sterling works as a financial services economy. But obviously the key to this is that the 10 spread continues to improve, because if the 10 spread doesn't improve, you can see what happens to the 2s. So for example here, the 10 spread dropped against the 2 spread. In other words, the 2's 10s is in trouble, isn't it? So this is actually taking your analysis beyond what Westpac produced. And you were able to then recognize that this 2's 10s narrative here was very, very definitely an opportunity to sell sterling, especially when the 2's started to drop as well. So you can start to recognize that this is a negative scenario. However, if we zoom in during this period here, we can see that the 2's 10s is lagging way behind, and that's going to give us some macro buyable opportunities, especially a candle like this. This is huge, right? Especially a candle like that. You can see the 2 spreads going up, the 10 spreads going up, the 10 spreads leading the 2 spreads. And that's a brilliant opportunity to get long sterling for a big, big, big macro swing pop, which is beautiful. Now, obviously, we can start to recognize how this evolves. Let's go along to the right-hand edge. You can see a perfect example of a long pound trade here. 2 spreads is cheap. That pulls the trade down. The 2 swaps is cheap. And then we get the 10 spreads, very, very aggressive. Very nice opportunity to buy sterling into those low prices. And you see that we got a very, very nice multi-day rally through that period. When the 2 spread dropped and then rallied, you can already recognize the opportunity on a macro scale to buy pounds in that candle there, for example. Huge, huge profit on sterling longs. And massive outcomes, massive outcomes. Now, the problem we've got for sterling, which is one of the things that the Westpac boys don't really go into, and perhaps they should redo their education a little bit, was the fact that we started to see the 2's going too high against the 10s. In other words, the curve had weakened on sterling. So that would keep the sterling price a little bit overpriced. And therefore, as a result, I would be looking for sterling, especially on strong up candles against the divergent story, more on the short side than the long side. Now, when the 10s improved, that's obviously relieved the short pressure somewhat. So obviously what we could now be watching for is a 2's decline, which is going to put pressure on sterling on the 2-year swaps. And that could mean that sterling could end up down below this price. And if the 2's declined and the 10 stayed bullish, that would be a buy trade on sterling. That would be a buy trade in sterling. And that's a dead easy trade. Now, on a 5-minute chart, you don't really see much on the 2 swaps. They don't really move that much, but you can see enough. You can see enough, can't you? So here's an example of what happened. We saw the improvement, the gradual improvement of both spreads over the course of the day session. That was the reason why we started. Remember, prior to this overnight session doesn't work. There's no UK data until 8 o'clock, of course. So it's only from 8 o'clock that we're reading, okay? Only from 8 o'clock that we're reading. So what happened is this 2's 10 starts to drop against the 10's that is now rallying. And because of that, you're starting to think, well, that 2 spread is going to start dropping the pound off of these highs. When that drops, of course, if the 10 spread stays bullish, that's great news, because that's going to give us a brilliant opportunity to buy sterling into the lows. And there's the 2 candles that you want to buy into sterling. There's the 2 candles there, because we've now got a 2's 10's improvement. We've now got a 2's 10's improvement into the low price, and we've got a spread trade improvement, haven't we? So when we look at the 2's 10's improvement, we start watching for that 2's 10 starting to improve off the low price here, which happened obviously because we showed you that earlier. We showed you the 2's 10's improving. Sorry guys, that's the Germans. That's the Germans. So we saw the 2's 10's improving into this low price, not on this candle, but on the very, very, very bottom tick candle. And that gave us the perfect opportunity to buy some sterling off the lows inside of that storyline. The 2's 10's, perfect, right? So we've got to try and do this type of work, haven't we? It comes back to the class we did this morning in the room, and that is to try and understand what it is that big boys are looking at and try and improve on their analysis by adding in some short-term ideas and understanding what it is they're talking about here and trying to replicate their thoughts. And then disagree with them if we want to. At the end of the day, it's only Westpac. They're not exactly world-renowned for being the best trading bank on the planet. So, you know, you should always be able to beat Westpac's analysis, surely to goodness. Anyway, as far as the Aussie yen is concerned, obviously Westpac is a little bit more in tune with the Aussie yen analysis. And again, as a forex market, of course, Westpac are right in the vicinity for these boys, right? So let's take a look at what they think about Aussie yen. So this is Westpac's Aussie yen view, strategic views for the Australian dollar cross. You can see the Aussie yen is often referred to as a risk barometer. No shit, Sherlock, I must have came to this classroom, right? And usually for good reason. During sharp movements in global equity sentiment, Aussie dollar tends to outperform on the upside and underperform on the downside. Japanese yen has historically been a safe haven aspect that sees it underperform when risk appetite is buoyant and outperform during flights to safety. Well, we know that. We use the Aussie yen extensively as a risk barometer ourselves, so we understand this. The GFC is an obvious example. The Aussie yen rising from 80 in early 2005 to 104 in July 2008, then tumbling back to 55 in October 2008. As the upper chart across shows, the daily relationship remains strong and has tended higher in recent weeks. However, as the lower chart shows, this is very much an Aussie dollar correlation with equities, and Aussie dollar tracking closely. The yen is a minor contributor, if at all. So they're really looking at the Aussie dollar as opposed to the Aussie yen. Indeed, the 60-day correlation of dollar yen daily log returns with MSCI World is just 0.1. It's not exactly a strong correlation if it's only 0.1. It's almost a no correlation at all. It's not negative, it's just neutral. And in recent months has more often been somewhat negative. In other words, a daily rise in equities was slightly more likely to be accompanied by a fall in dollar yen. Still, our baseline forecast of a strong end to 2021 for the global economy and central bank policy settings remains overwhelmingly stimulatory, should bode well for risk appetite and thus Aussie dollar Japanese yen. But to reach your year-end forecast of 86.5, currently 81 today, the Aussie will have to do heavy lifting, backed by a much more favourable domestic economic situation. This, of course, means an economy that has emerged from lockdowns and is rebounding sharply, backed by vaccination coverage high by international standards. We remain hopeful that this will be the case by late Q4. Australia's weekly vaccination pace has accelerated sharply, especially in New South Wales. And by Q4, supply of Pfizer and Moderna should help drive renewed demand, and the RBA would feel validated in trimming QE pace to 3 billion per week from November, whereas BOJ policy is very likely to remain unchanged. So you can start to look at these ideas. You can start to look at these storylines of looking for the Aussie yen to improve on a bounce. Well, that's not a surprise. The idea of the Aussie yen being a barometer, that's not a surprise. They're all things we teach in the classroom, of course, this idea of making sure that you check and track your Aussie yen barometer. That's why we did a class this morning. Remember we talked about it this morning? We looked at the A's and the C's against the S's and the J's so that we're not reliant purely on the A's. We're also adding Canada into that mix. It becomes a barometer, it becomes a risk barometer that we can use for interest rate curves, for equity markets, for bond markets, for oil markets, for all sorts of markets, guys. Anyway, we're going to be getting into classroom in 20 minutes. See if there's any other macros that we could have a little look at.